Hi, this is Randy Finney of Right Side of the Chart, and today is Thursday, February 2nd, 2012. And today I wanted to do a quick video update over on one of my existing trades, and this is Caterpillar. And I'm choosing this trade for no particular reason other than just to sort of illustrate, my thinking, my thought process on some of these trades, and how this one ties into not just the shorter term charts but the bigger picture. In fact, last night when I was wrapping up that video update on the VIX that I did, it was getting kind of late and I only had time to go through a handful of charts, and this is one of the existing positions. So again, not that this trade stands out more than any other. I just wanted to kind of go over the charts from the monthly all the way in and just illustrate how I like to use a top-down approach on some of these trades. So let's start with, well, I'm here on the daily chart right now, and as you can see, if anybody who had taken the trade will remember, I recommended as a possible short recently right here at this level, which was, there's a nice gap here on the daily chart, another gap back here, and yet another gap, and so this is a very solid resistance line. Now, of course, line didn't hold, and the stock had gone up, I think, about another, I don't know, maybe 5-6%. Currently, it's about 3.5% or so above the entry point. So, as far as a swing trade, which I plan this to be, at least in my book, that's fine. This stock is very close to all-time highs, which should act as resistance. And of course, if it breaks above there and runs, then there's nothing but blue sky. And at that point, it'll be a stop out and a relatively small loss, and I'm fine with that. Again, trades are all about looking at the risk versus the return. And I think if things play out like they might here, there's a lot more downside potential on this stock than near-term upside potential. In other words, you might give up 8, maybe 10% on the downside to swing down 30% or more if the stock turns down here soon. So let me zoom out now to the monthly chart and start from there. Okay, this is, as I said, I like to take a top-down approach when trading stocks, especially swing trade candidates. A swing trade meaning I plan to be in that stock longer for just a few minutes, few hours, or few days. I have a variable trading style. Sometimes I do day trade. Sometimes I'm in for just a few days, depending on market conditions and what void in my portfolio I'm trying to fill. I have different accounts. I have long-term accounts, IRAs, and such, and I have my trading account, which I tend to be more active in, although I do swing trade in that account as well, sometimes for months on some stocks. Okay, this is a monthly chart of Caterpillar, and as you see here, focus on these white lines. You have a pretty well-defined uptrend channel, and keep in mind, if you look at the time scaling down here, this is a looks to be about a 24-year, 26-year chart, something along those lines. Goes all the way back to, looks like 1984, and this is the primary uptrend Caterpillar has been in. And as my notes over here say, when I look at a chart like this, what jumps out at me immediately are these sub-uptrend lines I drew here in yellow within the bigger uptrend. And so you have uptrends within an uptrend. And when you get those, and they're pretty well defined as well, you get those breaks and you tend to have impulsive selling, which again, as I've mentioned in the past, that helps validate a trend line to me. At the point of the breakdown, if you see an impulsive move down, such as a large red candlestick like this, increase in volume, that helps confirm to me that that was indeed a valid trend line. But of course, ultimately, it's not rocket science. You look how many candlestick wicks or candlestick tails or bodies touch this line. It's pretty well defined in my opinion. And as I note here, it seems to me there's a pattern here that these trend lines, each progressive trend line has become steeper and steeper as far as the slope goes. And you tend, usually but not always, the steeper the trend line is, the sharper the the correction is once that trend line breaks. Another pattern I've noticed on these yellow trend lines, these larger uptrends within the channel, is once you get a break, typically, let's go back to this first one here, you get a push back up. And that's very common on breakdowns, whether it's a wedge pattern, just a plain old trend line break, a channel. You get the initial thrust down and then another push back up. A new wave of buyers steps in. And very often you'll get a retest of that trend line. In this case, you had a little bit of an overshoot. It retested the line and then some, and then quickly failed and fell down pretty hard. Here you had another breakdown, about a near perfect retest of both the trend line and the channel. That's a great objective short there. In my book, when you can line up more than one level of resistance, such as a trend line here and this primary channel line, then that's just makes the odds on the trade a whole lot better. And after that retest, you had another little thrust up, failed to make new highs, and then poof, there was the bear market in '08. And since then, we've had this very sharp, steep, powerful uptrend line. I mean, pay attention to not just the slope of the line, but look at the duration. That we started from here to here, which is approximately how far we went from here to here. This one was a little bit long. Then again, this was during the longest bull market in history, so it only makes sense that that's a longer than usual uptrend line. And here we had one not so different from about the move that these last two have been. So that's where we're at, and that puts Caterpillar, at least in my book, in a we'll call it a short-term uptrend, intermediate-term downtrend, and possibly the beginning of a longer-term primary downtrend. And again, as my notes up here imply, you'll often see after those larger trend line breaks within the channel, smaller uptrend lines set up. And you can trade off those. Again, folks, keep in mind this is a monthly chart, so not an exact timing indicator, and that's why we're going to drill down all the way to the 60-minute charts. So there's what I see when I look at this stock, and here we are right now with setting up and possibly another smaller uptrend line. Like every other trend line break in the past, we've seen prices fall, push back up at or near, sometimes even above the original or the prior high, I should say. In this case, back in '97, it looks like we did make a higher high after the trend line break. And again, we did that in 2005, 2006. It didn't happen back here, and it may or may not happen here. If it does, a great objective short area would be, again, this primary, the top of this primary uptrend channel. If we get there, Cat will have made new highs. That would have really pulled in a lot of bulls, flushed out a lot of shorts at that point. And so if I'm stopped out of this trade in the next few days or few weeks here, I'll probably look to re-enter up there if we get to that point. And then again, once this trend line breaks. Okay, let me stop here for a second. Okay, guys, this is a weekly chart I have now thrown up here. And real quickly, we'll look at this trend line. This one goes back just a few years here, couple years, and this would be in that monthly chart we were just viewing, one of the most recent yellow uptrend line that I had there, and hence you see the breakdown here, push down, and a retest of that trend line and the subsequent failure, and where we're at today, pushing back up. Right now we're about at the point of the last retest, and this is the level I put up on the cat chart just about a week or so ago, showing that as a possible short here. We have this level, quite a few reactions off this line that I'm highlighting here. There's a big gap here between these two lines, and I love to trade gaps. Trade off of gaps, that is, especially if they line up. What I look for is not just a gap in itself, but if it lines up with other reactions on either side, the top or the bottom of the gap, which this one does. and of course we punched through and filled that gap, which is pretty common in trading. We went to the top of the gap, right here, stopped. I'll highlight this a little bit more on the daily chart and talk about some levels. And then here is the recent high, which is also, I believe, the all-time high in Caterpillar. Let me pull up some indicators here. Okay, guys, I put up a few indicators here, which we're going to talk about. The first being one of my favorite. If there were probably only one indicator I could throw up on my charts, that would be the MACD. My recommendation to anybody new in trading, there's a gazillion indicators out there, and I do use a lot. I don't always put them up on the charts that I show, but my recommendation to anybody is look at them all, read up on this, and play around with them, and then find one or two that you like, and learn those inside out. Know them well, stick with them. I believe in the old KISS rule with trading. Keep it simple, stupid. I often see traders throw up charts that are so busy it makes my head spin. I mean, gazillion indicators and notes and this and that and moving averages galore. Maybe some people out there have the brain of a supercomputer, but most people, when you try to track too many indicators and keep your eye on too many things, it's like trying to hold sand in your hand. A lot of it's just going to slip through your fingers and slide out. You're going to miss a lot of stuff. So that's my recommendation. You find a few and stick with them. Anyways, here's the old tried and true MACD, which is probably one of the most common indicators, and for a reason, I believe, because it works well. What I'm going to focus on today are mainly these MACD, the bullish and bearish crossovers. You have the fast line, the 1226 line, and then the 9 EMA line, the white line, or the slow line. And when the slow line crosses the fast, or when the fast line crosses over either above or below the slow line, that's often considered a bullish or bearish signal. Excuse me. Okay, so what we're looking at here, I personally try to discard or not focus too much when the MACD is flat like this, very flat, and you get these crossovers. That tends to lead to a lot of whipsaws. But when you have a bigger spread between the two lines and you get a crossover, those are much better signals in my opinion. And then another tool to use in conjunction with the MACD is the MACD histogram down here on the bottom. And this is going to help illustrate, obviously, when there's a larger difference between the two lines, as you see here, you get a much higher and more distinct positive reading, positive bars on the MACD histogram. So point that I'm trying to make is back here, the MACD cat was in a strong uptrend with very little pullbacks, very little spikes. It was just moving up slow and steady in a bull market. And as such, the MACD wasn't giving you a lot of signals, and if they were more prone to whipsaws. So I tend to back away from it in times like this, but where I think it really shines is when you have volatility or a lot of price movements, and then you get these higher peak readings. So a couple things to note on that. Number one are divergences. Divergences can be drawn on just about any indicator, and hopefully most of you know how to recognize divergences. It's when you get a peak. For example, these yellow trend lines that I put here, you have a peak to peak, higher high in prices. There was a reaction high there. The next high before it turned down was higher, so you have an upsloping trend line. And then if you can just use a vertical line and see that these line up, which only makes sense. You have a higher high in the MACD and then a lower high here, hence negative divergence. Prices moving up against the MACD going down. And I can tell you there is, I always say there's nothing 100% in trading, but when you see divergences like this, especially if you can confirm those on other indicators such as the stochastics, RSI, any other indicators you're using, it just strengthens the odds that you're going to see a pullback in prices pretty soon. And that was, of course, the case here. Let's look at that. This scaling, keep in mind, is pretty compressed. I've squeezed this chart, and you're looking at a weekly chart here. So that is a pretty significant pullback at that point after that divergence. And it pulled back right to the uptrend line, which actually starts off this chart. This uptrend line goes back a ways. So, a buyer would have been at least on alert. If not had already taken profits here, you would have raised stops. Traders who like to trade on the short side would have been looking for a short entry here, probably on an uptrend line break. Let's say you drew an uptrend line here, smaller uptrend line. It looks like a rising wedge pattern to me, and you would have shorted there and took Caterpillar down to that level and covered at the trend line. At least that's how I would have played it back then. Now, what we see here, let's look at the bullish side as well. Of course, here's some positive divergence, looking at the MACD histogram, lower peak, higher peak, prices went lower from this point to this point, and then conversely you had a sharp move higher. So divergences work both ways, positive or negative, and with the volatility really heating up in the last half of 2011, you're getting much more distinct movements in the MACD, and some pretty powerful signals which are leading to bigger moves. The stronger the differences in the MACD, that's reflective of the volatility in the stock. So you had this big sell-off in Caterpillar, made a much lower low, and this was just a beautiful long entry. I mean, at this point, the markets were showing the same divergence. I posted back then at the time being short down to here and covered literally to the pennies when the Qs hit my target of 50 and went long at that point. And that would have been the same day, I'm sure, Caterpillar and everything else reversed. So you can see that strong positive divergence, not just on the MACD. You had positive divergence on the RSI here, on the MACD itself and the MACD histogram, and that is about as close to you can get as a fail-safe signal to get long. Again, we're looking at a weekly chart, so you'd want to zero in on the daily, maybe even the 60-minute charts for your timing entry, but at that point it was towing the shorts. You don't want to stay short much longer in this stock. And here we are today, and this is what I wanted to point out. CAT is currently on the watch list as a short trade, and as you can see here, we've made from this price peak here to this level. Let's put some crosshairs on it so you can see how that lines up. Look at this high in the MACD histogram. That's the highest in years. MACD histogram has now turned back down. That's one thing I look for when trying to identify divergence. I want to see the MACD curl down, which it's done here. You can see the MACD is curled down. It has not yet made a cross. When that blue line, that fast line, crosses that slow line, that will officially have made a bearish cross down, and you're going to see these bars down here turn red. And however, that divergence is in place right now on this histogram, because these bars have clearly come down, and so now you're looking at some pretty nice negative divergence on the MACD histogram. On a smaller scale within back here, you can see some positive divergence, or what some people call flatline divergence. You had equal lows at these 2 points here, okay, and a higher high on the MACD, and that led to a bounce as well. So bigger picture, we're looking at some pretty strong divergences on the weekly chart. Now let's zoom into the daily chart. Okay, this is a daily chart here, and what we're going to look at are price levels. I first posted CAT as a short when it was up against this level here, which, as I talked in the beginning, that's a gap at this point. We had a gap over here, another gap here, and some price reaction. So I thought that was a pretty good level, but the stock prices punched through there. And as unfortunately I often do in hindsight, I'm going to zoom into the 60-minute chart and tell you why I may have jumped the gun on that trade, but I am still with it currently. The market is trading now, so we're basically where we were yesterday, which is only from 106 and change to 110. That's what, less than 4 points, 3.5 points, so about 3% loss on this position so far. And at the highs, I think if you hit this level, I didn't have these lines in here at the time, but as you can see, this is also these are the next two resistance levels, these lines here. We have a gap at this point, So this horizontal line hits that gap and that prior reaction high. This is when CAT recently tried to make a new high and failed, which is pretty bullish. Broke out to a new high, which in itself, I'm sorry, that's a bearish thing, the fact that it failed. We broke out to a new high back here in May when the markets peaked out. And usually you see a new wave of buyers come in when a stock makes a new high because at that point there are no remorseful buyers. Everybody holding the stock when it makes a new high is profitable, or at least break even on the trade. You don't have anybody underwater, as that makes sense. Conversely, when a stock makes an all-time low, every single person in that stock, other than anybody that just bought, is at a loss, and that's why a new low is very bearish and tends to usher in more selling. So either way, the new high failed, CAT fell down, and of course we already covered the longer term charts. Came back up, hit a trend line retest, had a nice sell-off, and now here we are again. CAT's getting ready to challenge its all-time highs, and folks, I will say, if it breaks above this level and sustains that, then that is in itself a bullish thing. So let's watch for it. It's possible it makes another failed attempt. I pointed out on the longer term charts that if it does break out to new highs, you have a multi-year, multi-decade actual trend line coming in, not too much higher, and that's where I'll look to try again on CAT. But I will concede and stop out somewhere above this point. Again, taking a look at everything else, looking how the broad market is at that time, and other factors. Let's put up some indicators here. Okay, here we are with a few indicators up. I have the pretty much the same thing I just had on the weekly chart before. And being this is a daily chart we're looking at now, these indicators, everything looks pretty much the same. Just to run through them real quick, we have this impending turn down in the MACD right here. As you can see, the MACD is poised to cross. In fact, it's if you look at the histogram, that is a way of zooming in and looking at the difference between these two lines. We're right here, 0.23. So we're looking at a pretty much an impending cross. Don't try to get ahead of myself, but that if you look at the history of this histogram, especially when you get these large moves up, I tend to not pay much attention when you get these little moves in and out because it leads to a lot of whipsaws and false signals. I don't find that useful. I like to look at the bigger differences in the MACD. So there we're at. We're looking at a impending cross in the MACD. I didn't draw it on here, but the same divergences exist. We have a lower on the blue here. We have a lower low, or lower high. A lower high against prices that have made higher highs. So there's negative divergence from. I'll just do the crosshairs. You guys can look up and down. And everything on here is similar to the weekly chart I just showed on those divergences. Let's look at this daily RSI. I've talked on this before. The red line here is the 70 level, which is considered overbought on the RSI. And let's change. Let's get that crosshair to do this. And I'm just going to look at those levels, and I'm putting the crosshairs on the RSI 70 levels, and you can look at what happened to prices after that. Again, I have this chart compressed, but that's a pretty good size pullback in CAT if you look at the numbers. We're in a strong uptrend here. We did get a pullback. We crossed 70 here, went up for a little bit, and there was a decent pullback. Nothing to write home about. You could have made a quick trade off that, and then we fell back below the line. Again, we hit 70. Oops, trying to get these crosshairs right on there, and you can look up at prices and look at the pullbacks. Here was a period where the stock, was in a very strong uptrend. RSI stayed above 70 without much of a pullback. Then again, the stock didn't go very far from this point. Look how it flattened out for a while. And again, 70. Look at the pullback up top that followed. There we go. I have it on right on the line there. Look at the pullback that ensued. Here's an RSI reading of 70 again. In the ensuing pullback, here's the next hit of 70. Prices managed to push back up to almost equal levels. I know it's hard to see in there. There is a small, looks like doji candlestick up here on this trend line that was the actual retest on this trend line, and then a lower high right here on the RSI. But either way, you would have shorted there. You would have never been underwater even on this push up. Prices didn't get back above. And look at the you know look at the swing short entry you could have had on Caterpillar, shorting it up around 110, right around current levels, and the stock going down to 67. That would have been a nice short. And here we are today. We pushed above that level, and yes, it got quite a bit higher, but now the RSI is turning down. And some traders will look for a cross above 70 and then wait for the break back down below for a confirmed entry. One other thing to point out, let's scale this down a little bit. You'll notice this gap here. There was a gap recently, a few days ago, and prices have failed to get above that level. And look at this volume bar. You may want to research this term if you're not familiar with it. It's called an exhaustion gap. It's after a stock has made a long extended run, and you get a gap up on a very high volume bar like that, and then subsequently prices fall back below and fail to get back above that level. That will often indicate, like the name implies, an exhaustion of buyers. A lot of people chasing Caterpillar in a frenzy. Oh, they hear all the hype on TV. China's turning around, and the economy's turning. I got to get into CAT. I know it's run up. I've been watching it, and you get that last group of longs that are sucked in, and pretty much you now the ratio of buyers to sellers in the stock turns. Now, too early to call that at this point, but I did want to point that out. It does have some of the makings of an exhaustion gap there. Okay, folks, to wrap this up, I thought this would be a quick 5-minute video, but they never are. So anyways, here's the CAT hourly, a 60-minute chart. And in the beginning of the video, I told you how, by putting that trade up recently, I thought that was an objective area to short, which I still believe it was. In hindsight, there's no two ways about that. CAT could have very easily turned down there. The market's at very overbought levels, so is Caterpillar. But what I should have put in conjunction with that chart, I don't believe that I did, is this 60-minute. Here we have a clear uptrend line. Yes, there was one little poke below, but if you count every candlestick, either tail or body that touches, you have a cluster here. There's one cluster, another cluster that created the trend line, a third cluster that confirmed the trend line, and then, as I said earlier, look at this volume. That impulsive selling down through the trend line. Again, when I see a trend line break, we don't always have to get it, but I like to see a volume, an impulsive breakdown below that trend line. Point is, the initial CAT trade, I believe, was put on at this level when prices were at support, somewhere around here, and we were still well within this uptrend line on the 60-minute. So a more objective entry would have been to wait for a break of that line, and in my opinion, an even more objective entry now because we're retesting that trend line. So again, guys, is CAT my favorite trade out there? No, absolutely not. It's just one that I wanted to highlight for everybody's benefit. How my thought process works. When I look at the bigger picture, drill down using multiple time frames to confirm entries and exits on trades, and from where we go from here on CAT. As I said, if the stock turns down in the next few weeks, that's probably only likely going to happen if the market turns down, then CAT could turn out to be a very lucrative longer-term swing short. If stocks consolidate here and or just break out of the recent trading range and move higher, and Caterpillar takes out its recent, or I should say all-time highs, which aren't too far away, then that's going to be bullish. And you watch the stock. As I mentioned, there's another key uptrend line, long-term uptrend line not far ahead. Maybe we'll look to reshort it at that point. And the other option, maybe we do break out to new highs, and it's a big fat bull trap, including Caterpillar. So if we break out to new highs and then impulsively failed back down below those levels, and the market's confirming that, and everything else confirms it, then even if I'm stopped out, I may re-enter the trade, and I'll try to keep you guys updated on that. Okay, hope you enjoyed it, and have a good trading day today. Thank you for watching.